Thank you so much, Janae. This is great. Yeah, welcome everyone to the Masterclass series. It's great to have actually so many people join us here today. We've been doing this event for a while now. So let me just point out the past sessions that we had, which can all be found, as Janae said, in terms of recordings on the SMS website or on the YouTube channel. Today, we have an exciting masterclass dealing with the demand side view of corporate strategy, but also please stay tuned for our next events. We have the next masterclass led by Tobias Kretschmer and Juan Santalo, who will share their insights on corporate strategy and platform markets. So Lisa and I have organized today's masterclass that is led by two amazing speakers. Let me just very briefly introduce the two who probably do not even need an introduction. We have Ron Adner, who's at the Tuck School of Business at Dartmouth. And Ron's work provides new insights into the impact of demand-side factors on competitive dynamics. And in particular, when industry boundaries break down, for example, in the wake of ecosystem disruption. And then we have Deepak Somaya, who's at the Gies College of Business at the University of Illinois. And Deepak's research focuses on knowledge assets such as human capital and technology, and in particular, the scalability of business models. Both Ron's work and Deepak's work highlight the need for greater attention to market opportunities and understanding business growth. While work in corporate strategy is traditionally informed by the resource-based view, we have two scholars here, as you can see, that are extremely well equipped to guide us through an exciting masterclass providing insights into a demand-side view of corporate strategy. And just for the agenda, we'll have around 20 minutes of presentations by both speakers. Deepak will start and Ron will go second. And then this is continued by a Q&A session. I, however, encourage you to already during the presentations, make notes of your questions. Please already type them into the chat if you can. And the Q&A session will be a very interactive one in the style of a traditional Zoom meeting in which you can unmute yourself and you can directly share your questions as well. So without any further ado, Deepak, the floor is yours, and I'm really looking forward to this.
Thank you, Teresa, and thank you for the kind welcome and introduction, and also for inviting me to be a part of this session. Let me make sure that my screen can be seen.
It's not in presentation mode yet. Yeah, now, perfect.
Now, yes.
Perfect.
Thank you. Perfect. All right. Thank you all for coming. I'm looking forward to this session, and of course also to the Q&A and to Ron's presentation. Let me start by making the usual caveats, right? This is going to be a somewhat idiosyncratic and possibly somewhat incomplete view. And of course, it's going to also reflect my own biases and my own perspectives. I'm going to focus a little bit more on my own prior work, although I'll also try to connect some of the other work that's relevant. And so I'm going to focus on two broad topics that I'll come to in just a minute. So as Teresa pointed out, there's been a longer series on the Corporate Strategy Masterclass, and many of those are quite relevant to the topic today, and I'm highlighting a few that are in particular quite connected to today's topic. The Masterclass on Strategic Redeployment, the one on divestments, the one on diversification, as well as the one on resource allocation. And I would certainly recommend those if you want to get a complementary perspective to what I'm going to be talking about today as well. Our focus today is on the demand side and corporate strategy, and I think it's important to highlight the sort of the background to all of this, which is the literature on the demand side. In many ways, Richard Priam's been at the center of this, along with several other co-authors who, among other things, really focused our attention on the customer and bringing the customer into strategy. So this is a literature that goes beyond just corporate strategy alone, right? But the idea of bringing the customer into strategy, strengthening considerations of value creation over value capture. And last but not least, there is sort of also this idea that we need to go beyond the resource-based view and or strategic positioning in the way that we think about demand. And I will sort of caveat that a little bit. I think that the two perspectives are quite complementary and build on each other. So rather than set them up in opposition, as you'll see in the talk today, there's going to be a lot of interaction between the resource-based view and the demand side. So as a broad agenda, I'm going to focus on two broad topics. One is thinking about the demand side as inducement, and the other is thinking about the demand side in terms of customer-specific synergies. Okay, so those are two broad lenses that I'm going to take. And let me start with the demand side as inducement as the first sort of area. Okay. So as always, with things related to corporate strategy and firm growth, and if you think about corporate strategy broadly, you would think about it as the study of the direction and pace of firm growth, right? So we go back to Penrose, and a lot of us are very familiar with the ideas of Penrose having to do with limits to the growth of the firm, particularly thinking about Slack and Slack managerial resources. But there's this other very interesting insight coming out of Penrose having to do with this term called inducements, which I think we should thank my colleague Akardi Sakratov and Tim Folter for bringing into the literature through their work. And as a very sort of simple definition, they describe it as performance advantages of new over existing businesses. And Penrose had a sort of somewhat longer and interesting quote about how to think about inducements, right? So she was emphasizing not only that the declining profitability of existing markets might be an important factor, but that might be a special case of more generally thinking about opportunity costs for the firm and its resources, right? And she highlights that that can also occur because of the rise of new opportunities for investment, as well as because of decline of the old. So, essentially, if you think about this quote, the opportunity cost logic is central to the idea of inducements. And so the way these inducements from the demand side might affect corporate strategy is to think about the demand side as creating changes or shocks that shift the relative value of where you allocate your resources. And then those inducements in turn would lead to resource redeployment, right? So, and particularly if you think about resources that are so-called non-scale free, right? So if the resources are scale free, there is no opportunity cost in terms of redeployment. But anytime you think of a resource or a resource bundle that is non-scale free, then there is a choice to be made as to where you allocate the resources. And that results in an opportunity cost logic. And so these demand side inducements will then produce changes in corporate scope. So demand here acts as a shift parameter, if you will, to the inducements that the firm runs into. And importantly, this logic does not depend on considerations of gross profitability. For example, if you think about entry conditions into new markets in sort of a free entry kind of market, there you worry more about profitability, and it's profitability greater than zero, less than zero, and so on. Here, it's not a logic of gross profitability, but of relative profitability, right? It's a matter of comparing alternatives in terms of where you allocate your resources, and the opportunity that's foregone essentially presents the opportunity cost. And also importantly, this is not really a logic of resource relatedness necessarily, because resources might be somewhat unrelated between businesses, but there's also sort of a consideration of how much value there is in reallocating resources in that direction, right? So it's a combination of resource reallocation costs and the value that comes from resource reallocation. So I mentioned a few of the papers in this stream here. There are many more that we'll also sort of see as we go along. And now this logic can be applied not only to multi-business firms, so you can think about diversification or which businesses firms want to be in, but you can also apply it to multinational firms. So research has certainly done that. You can think about this in terms of demand changes that are positive or negative. So you can see inducements occur in obviously different directions depending on the changes in demand, up or down. And there's a wide range of factors that could cause these kinds of demand changes, right? So you could think about regulation, policy changes, trade barriers, et cetera, et cetera. And then in turn, if you're thinking about this as a logic of essentially resource reallocation in response to these inducements, there are many other factors that could also affect this, including whether you made strategic commitments to one business or another, and therefore it's harder to reallocate resources away from that business, or there might be adjustment costs in the redeployment, or there's, as I mentioned earlier, the reallocation logic primarily applies to non-scale-free resources. So if the resources are scale-free, you could actually reallocate them without too much trouble. And then also you could think about the coordination needs across businesses and so on and so forth. Right? So a number of factors could moderate this relationship. So, and Teresa, in her work with several colleagues, Tim Folta primarily, but also Juan Santalo and Marco Giarratana, then takes this idea of inducements and reallocation and actually highlights the possibility that multi-business firms might actually have some dynamic advantages as a result of being able to reallocate resources in response to inducements, right? So, for example, the core idea here is that the multi-business firm might be able to more flexibly respond to demand changes than single business firms. In some of their work, they find that multi-business firms both expand and retrench resources more aggressively than single business firms, and that the value of such flexibility would increase with uncertainty. So you can think about being a multi-business firm as creating option values for companies. And then Arkady, in some of his work, also sort of shows that this value would increase with the flexibility of switching, with redeployment experience, and where there's inverse correlation in returns across businesses, which is somewhat counterintuitive in some ways to thinking about diversification more generally. And then in some other work, Tim Folta with Timo Sol also shows that multi-business firms, they tend to exit markets at higher rates because of the ability to redeploy, right? So completely exiting from markets as well. So one thing that I should highlight here is that the key sort of boundary condition to all of this that's underlying the mechanism here, the theoretical mechanism, is that redeployment only occurs within the firm, right? So as long as you're thinking about redeployment within the firm, that gives these firms an advantage, right, relative to redeployment to the market, for example. So there's another stream of work in this literature that looks at how ex-ante corporate strategies the firms are already undertaking, how they might affect responses to demand shifts. So this is, instead of looking at how demand shifts affect corporate strategy, kind of taking the opposite perspective, if you will, and in particular, sort of thinking about the firm's extent corporate strategy as a source of coordination costs, which then create problems and adjustment. And so this is work looking at how vertically integrated firms might be less successful in responding to demand and therefore exit more frequently, and also how firms might reduce adaptation or might have poorer adaptation if there are interdependencies that have to span organizational boundaries. So I want to turn briefly to some of my own work that connects to this broader literature, and this is the theory work is with Gigi, Toby Kretschmer, and Brian Wu, where we think about scalability and how scalability might come about, and then how that in turn affects corporate strategy decisions, particularly in terms of the scope of the firm, whether you have a narrow or a broader scope. And one way to think about this is if you think about what scalability means, fundamentally, it's a concept that measures how value creation by the firm changes with resource use, right? So you could think about, particularly in digital firms, for example, that there might be this sort of increasing returns type phenomenon where as you apply more resources in sort of the typical sort of declining returns, you might actually get increasing returns in the graph on the right-hand side here, right? And where might those increasing returns come from? And usually we think about that in terms of, and again, thinking particularly in terms of digital firms, we tend to think about that as coming from the resources of the firm, right? So the digital resources tend to have very low marginal costs, and so they can easily be scaled up without incurring a lot of resources. But even in those cases where you could actually have some supply side or resource-based economies of scale, that could be undermined if you have relatively rapidly declining demand, right? So marginal demand, if it's relatively rapidly declining, so a conventional downward sloping demand curve, you might be able to produce goods more cheaply, but if there isn't demand, then you're not able to create as much value. So there's also an argument from the demand side, thinking about these kinds of digital firms where you might have demand side returns to scale. And we're very familiar with the general idea that, with network effects, for example, that you could have these kinds of demand side returns to scale. And particularly these days with platform type markets, you'll see a lot of this, right? So there's also this region here where the demand side might create these increasing returns to scale and could drive this phenomenon of scalability. And as I mentioned on the flip side, if the demand side does not materialize, then even with scale advantages on the supply side, meaning from the resource base, that's this space down here, you might not actually get those scalable advantages. And in turn, what that translates into are choices about firm scope. So we show in this theory paper that the greater the scalability, the greater the tendency to specialize, and that's on the right-hand side. And then that specialization in turn creates incentives for firms to invest more aggressively in the business, right? So that the two of them feed on each other in that way. And in more recent work, which is still a working paper, we also show that there's, using an exogenous shock to scalability, we actually show that firm scope, in this case, the shock is a negative shock to scalability. So when scalability goes down, firm scope actually goes up. All right, so let me now transition to thinking about the demand side and customer-specific synergies. So far, primarily, we focused on this idea that there might be some exogenous changes to demand or some particular demand characteristics that then feed into corporate strategy. But we haven't talked about sort of the existing customers of the firm and how they might make a difference, right? So those demand shocks that we've talked about could happen to any set of customers, could be in any market. And I think a good place to start, again, is with Penrose, where Penrose does think about existing customers and describes existing customers as giving companies an inside track to demand changes, right? And so primarily the way to think about this is that existing customers can be a source of information, right? You can give firms an information advantage, and that might then in turn lead to a better understanding of the market or where consumer demand might come from, and accordingly, firms could make resource reallocation decisions. But arguably, if you think about this logic, essentially existing customers primarily are just a channel for information about demand shifts, right? The demand shifts that we looked at earlier is essentially a channel for information. And you might even question as to whether it's the best channel for information. There's a lot of work in disruption, for example, that argues that existing customers might not be very useful for predicting future market demand in certain conditions. So, take that with that grain of salt there, right? But I think what's more interesting is thinking about these kind of customer-specific synergies, if you will. And I'll start with a very specific example that Ye, Prem, and Ashwar describe in their 2012 paper, because it's really something that sort of clarifies the logic a little bit more for us. So essentially, they present a logic for product bundling to the same customer, and that's the important thing here, right? So the same customer, they're bundling products. And essentially, the example they provide is one of a laundromat and a tanning salon in the same location in a college town. And the logic of why these two businesses are together is very hard to argue that there's actually some common resource base that's really driving this. And instead, their argument essentially is that customers, especially women customers who come in to do their laundry, it's a time-efficient way to sort of get their laundry done and also get their tanning done at the same time. And then they also describe that because the women are hanging out there, that the men also show up to do their laundry in the same location. So extrapolating from there, you could think about sort of a one-stop shop argument for facilitating customer bundling. And then, particularly thinking about a platform type product, one set of consumer groups or one consumer group being there, then creates intergroup externalities, which draws other consumers as well. And so now you have a logic essentially of diversification without necessarily having superior resources, right? And so one can think about these customer-specific synergies more broadly. I think a good paper to kind of get a nice introduction to them is this paper by Schmidt, McAdoo, and Keel. It's a theory paper, but describes several different types of customer-specific synergies. You could think about cross-selling as one example. You already have a customer, you're selling one product. You could also sell another product while you have their time and attention. You could also generate synergies through superior coordination between products, better integration between complementary products or complementary elements of a product, and also compatibility between products, right? So these are really about advantages on the customer side, the customer that's using the product and it benefits from and appreciates the fact that they can actually use these products more seamlessly. Similarly, you could have a logic based on reduced shopping or search costs, or also customer-specific knowledge or resources that a firm might have. And so building on this idea, there's been other work that's actually looked at a customer relationship-based logic for diversification. I'll mention this paper by Munro and Kathy Harrigan, but also this other paper by Wang, Agarwal, and Wu looking at how firms differentially adapt, right, to increasing versus decreasing demand. And I will then transition now to two papers of mine that sort of highlight the same kind of idea. And these papers are, interestingly enough, in the context of legal services. So you can think about this in the context of professional services more generally. And this is a context in particular that's sort of ripe for this type of theory and analysis, because there's actually sort of enduring and important customer relationships, and those customer relationships that then might affect corporate strategies and the direction of growth quite meaningfully. So in this paper in 2018, that's published in SMJ, we talk about a logic for client-led diversification. And the logic is quite simple. So if you think about this graph on the left here, describing a firm's footprint across several different markets. Essentially, we say that the supplier here is sort of more or less conforming to the markets that its clients are in. And what happens if these clients then change the markets that they are operating in, right? So in many types of professional services, clients specialize in different domains, and you can imagine their service providers then making choices about where they should go. So if you see this change in clients in time one, what should happen in time two in terms of where the suppliers go? And the basic logic is that the suppliers tend to follow their clients, at least to some degree. And you can imagine why this might be. And again, here there's sort of different kinds of advantages that stem from the supplier's existing relationship with their clients, and those advantages might in turn amplify these effects, right? So in particular, we show that the greater the client-specific knowledge, the more likely it is that the suppliers will follow their clients. The stronger the relational commitment from the clients, the more likely it is that they'll follow their clients. And we also hypothesize kind of an inducement-based main effect, which we didn't really find any support for, right? So it's not really affected by relative opportunity in the broader market in these different areas. So it seems that the client specific synergies are a very strong driver here of diversification. And then in the second paper in org science, we look at how customer relationships, the embeddedness of firms in their customer relationships, in turn affects overall growth. And you can imagine a firm here that's a supplier to a bunch of different clients. They have different degrees of embeddedness, and we're looking at the average level of embeddedness the firm has with its clients. Is it more or less embedded with its clients in terms of their past history of working for the same clients versus working for multiple clients? And in turn, sort of ask how this might affect the direction of growth. And our logic is primarily one of added value opportunity. So among these existing clients, are there opportunities to create more value for these clients? And that in turn might affect the opportunities for growth that these firms have, right? And the overall logic essentially is that relational embeddedness with customers might both foster and hinder growth depending on whether the added value opportunities are broader or narrower, right? So you can think about different types of customer specific synergies, the ability to cross-service, buyer commitment, that actually create broader added value opportunities, and others that might create narrower added value opportunities. And that we argue is essentially one of the drivers of growth of firms. Okay, let me pause here or stop here and hand you over to Ron, again, sort of highlighting the two main things that I looked at, right? Which is demand as inducement and customer-specific synergies.
Thank you so much, Deepak. Ron, I think, is setting up.
Here. Can you see my slide?
So far,
Okay.
not yet. No, I think now we see it. Perfect.
All right, perfect. Great. Well, good morning, everybody. At least those of us for whom it's morning. Everybody else, good afternoon. And that was super interesting from Deepak. And I'll try to share some additional ideas around demand, demand and corporate strategy specifically. I'm going to share really kind of ideas and a reflection from really thinking about the journey I've taken through the demand side. So this is, I'm not going to show anything comprehensive. I'm not going to show you anything that claims to like lay out the literature or even like the full body of work I've done on demand, but rather I took this as kind of an opportunity to reflect on dynamics and implications of the demand side, and maybe not surprisingly, specifically reflecting on demand heterogeneity as a critical part of thinking about demand. And so, we have, a supplier, we have a buyer, and when we talk about the demand side, it's that side of the slide that we're thinking about, obviously. And usually when we're thinking about the demand and consumer, we're thinking about willingness to pay, we're thinking about size of the market, we're thinking about the sorts of things that are driving the demand curve to where it is. And my entry point into this story was, by the way, I have to say, it's wonderful to have, when I was doing my dissertation in the mid-90s, the idea of doing something on demand within strategy was not so obvious, right? This was like the heyday for the research-based view, right? We're still, Porter versus RBV, what's going to dominate. And so it's great to see that there's been so much growth and interest in this side, both in terms of the direct ideas about customers and what we can do, but also about how the structure of demand affects the more traditional core strategy questions, which is really kind of where I'm going to push my comments. So, when I was starting this journey, kind of and keep in mind, I'm coming at this really with the innovation mindset of offers are going to change over time. And if you were going to talk about, innovation and the demand side for really a very long time, what you'd really be talking about is this guy Schmuckler, who's kind of anchoring the debate in terms of, is innovation, is it a market pull or a technology push? And in some ways, like the von Hippel stuff about user-driven innovation kind of builds on that. Deepak just talking about this client-led diversification within the legal profession. It's kind of a similar kind of thing of is the customer, a specific customer pulling you in a specific way. And what was interesting to me is that we were looking at customers and we were looking at technologies, but we were kind of talking about the market as though there is one representative consumer out there in the world. And when we look at what was happening in the marketing literature, marketing was obsessing over the fact that there are different kinds of customers in the world, right? Segmentation is core to their story. If you think about, where marketing, gets to their most interesting innovation stories, it's all about, adoption, innovation diffusion, and what is it that makes one customer adopt something before somebody else? And that tells you something about heterogeneity. But in the marketing literature, generally, even though they were very focused on demand heterogeneity in the context of innovation, the innovations they were looking at were very static, right? They didn't have this notion of technologies improving over time. And that was kind of, for me, the stepping point of thinking about how do we bring demand heterogeneity into the strategic discussion. And thinking not just about the static differences across consumers, willingness to pay, different thresholds that innovations need to cross in order to become relevant. But if we think about technologies as changing over time, the question becomes, how do consumers react? And do they react in a static way, meaning none of their orderings change, or does maybe something change in response to technological development in the way in which consumers are thinking about willingness to pay? And how does that change the demand structure, then change the way you think about developing technologies? And so the two starting concepts that I'll anchor for us are this idea of decreasing marginal utility from performance improvements, which I'd say powered the first 10 years of my career. And this realization that it may well be that even as firms are able to deliver more and more performance, the way in which that performance will be valued by consumers will change over time, right? And in particular, that at some point, the rate at which willingness to pay goes up will decrease. And this is going to have implications for how you're going to think about investing in innovation. And it's going to have some interesting implications for blurring segment boundaries for changing heterogeneity. And then the second concept is the structure of preferences across markets, across segments. And I think the interesting takeoff point is, some of you are probably familiar with this picture, Clay's work on disruption, where we had an old technology and then we had this new technology come in that was worse but good enough, and it displaces the old technology from its home market, right? His work in disk drives, you can think about kind of the low-cost airlines and the full-service airlines. And what was interesting here is that on the supply side, what we see is a story of technological substitution. Okay, there's one technology, and now here's this new technology taking over. But on the demand side, what we actually have here are two different segments. We have the home market for the old technology, and we have...
I'm afraid Ron broke off, right?
Not just me, right?
Yeah.
Well, why don't we take this opportunity to maybe answer a question?
I think so. That would be a good idea. Ron, I don't know if you're hearing us, or Deepak, would you mind taking a first question?
Sure, I'd be happy to.
That would be great, because we have a question by Kathy Harrigan, who already asked, and I think it was during your talk, so maybe it was also directed to you. How would you predict that declining demand affects the choice of vertical integration or a vertical integration strategy?
Yeah.
Would you take that one?
Yeah, Kathy, as you might expect, asked a very, very interesting and very meaningful question. And I think in some ways, the ideas that I shared around scalability, this is kind of the more general version of that question, right? Which is that if you think about demand overall for a business, if there is a value chain and there's sort of different relative returns to allocating a firm's resources across the value chain. And as long as demand is increasing and there's sort of therefore value to expanding output, a firm might choose to allocate its resources to the part of the value chain that provides the greatest return and have others specialize in other parts of the value chain. But once you sort of have declining demand, you then have to ask, okay, what is the inducement now? The inducement is actually no longer to continue to just expand within one part of the value chain, but also to expand to other parts of the value chain, if you will, right? So I think a nice example, if you think about it, is Apple starts out being very much in software, but then once it sort of sees that its demand is not nearly growing as fast and it has spare resources or slack resources, it then gets into chip design, for example. Looking for the most, essentially responding to the inducement and looking for opportunities to deploy resources into parts of the value chain that add the next highest level of return. You can also think about a lot of Amazon's sort of movement along its value chain, getting into logistics, for example, in a similar sort of lens, right? Shall we take some more questions while we wait for Ron?
Yeah, let's ask the audience, or I see that Kathy is also still here. I don't know if she wants to reply to your response, but maybe we can also take the next question if there are some.
Oh yeah, I'm here, and I was, of course, going to ask you if this had something to do with changing the resource deployment or going after a different group of customers. Is the essence of your demand-based view of the firm that you're going to stay with the same customers as opposed to search for something that matches up with your resource configuration?
Yeah, it's a great question. Because the question was specifically sort of framed around vertical integration. I mean, you could think about that as the sort of relevant margin, if you will, where the firms are making the decision. But they could also be thinking about the margin between existing businesses and new businesses. I think the interesting thing here is that while these changes in demand are happening, firms are also there's also changes in the resources of the firm that are also happening at the same time. So there might be incremental resources getting added as well. I think we might have Ron back.
Yeah.
Ron, we were just filling in time with questions.
And we'll give you a minute, I think, to set up your new setting.
And by the way, I think the question that I'm asking is actually
I'm in on.
Ron, maybe if you mute or if you turn off your camera, you might have more bandwidth. That might help.
Okay.
Yeah, I'll just make one final comment about the question that I was answering and then hand back to Ron. So I think the questions that Kathy is asking are actually super interesting, and I don't think there's been much work on it, if at all. So it's certainly an area of opportunity. What happens when you have declining demand or demand growing at a slower pace, and how do firms reallocate resources along the value chain, and especially trading off along the value chain versus other markets. So that's kind of a super interesting question that
Absolutely
is grist for new research. All right, back to you,
Ron. Can you hear me?
Yes.
You can. Okay, but you can't see me. And you can't see my slides because for some reason my computer is not connecting to the internet. So I came in on my phone. Apologies for that. This feels like early COVID days and connectivity. So all right. So the idea that I wanted to first. We'll do this without
Ron,
slides.
I'm afraid we can't really hear you well.
Can you hear me any better now?
A little bit better.
Okay.
Okay. Also, feel free if you want to send me your slides, if you have them, if you send me an email, maybe I can share them if that's an option.
You know what? All right. It looks like the internet just came back online, of course.
Okay.
I'm so sorry, everybody. This is not
not really the plan.
Well, this happens all the time, don't worry.
Right.
If you
Let me-
like, we can also take, I don't know, 1 or 2 more questions and you see if you can set up.
Yeah, if you can do that, and then I'll be back.
Yeah.
Okay.
I'll be back with my computer. And
Perfect.
we'll have the real thing.
Wonderful, wonderful.
And the good thing is we can also edit in post, so cut this out.
Okay, so yeah, just to provide everyone with the opportunity, now that we have Deepak to our full say, not, I don't want to say this full, but maybe are there additional questions? Well, I have some, if I may. So you were mentioning, yeah, especially these works on demand shocks and factors that create demand shocks, like tariff cuts and so on. And I'm wondering, can we learn from the demand side view and from these demand shocks something for, let's say, these more sudden, even supply side shocks? So basically, should we take the demand side view and actually, yeah, learn something from that? I think you've mentioned the work by Chris and Yasmina, and there is some initial work on supply side shocks,
Yeah.
but I think way less. What's your take on this?
Yeah, that's a great question. And in fact, I considered mentioning the other paper by Yasmina as well, which looks at this idea of supply side inducements, right? So how inducements might occur from the supply side. And I didn't because I was, limited amount of time, and let's focus on the demand side. But there is this other work that's emerging. I think the thing that ties all of it together is how does it affect inducements, right?
Mm-hmm.
You could have kind of this changing opportunity cost that firms face that could occur either because this changes in demand, that could be some type of shock, it could be a more steady growth, it could be decline, it could be unanticipated reductions in demand. But these kinds of changes to adjustment or to inducements can also occur because, exactly as you point out, on the supply side, if you will, right? And in Yasmina's paper, it's a case of I think unexpected death of managers or something like that, right? It's a human capital shock, right? There's sort of there's suddenly a need for resources that results in reallocation within the firm. I think what would be really interesting going forward is a more broader integration of both those elements, along with the dynamic changes of the resource base of the firm, because of course firms are not static. They're not waiting for these inducements to change. They're also augmenting their stock of resources all the time, and there's also at the same time sort of in addition to demand shifts, there's also sort of a natural cadence of markets in terms of growth and maturity and so on. So I think combining these elements together provides a fuller picture of how firms should change their boundaries and grow through an inducement lens.
Great. So let's see, where were we? So the starting idea was we have some measure of differences among consumers. And the first point is that difference can change over time, right? From the demand side itself, when we have decreasing marginal utility from performance improvements, essentially what happens, two segments that starts off separate begin to converge. And we can also think about the relationship in terms of the preferences between those two segments as giving us an indication of what that joining will look like. So, in the classic disk drive story, it was small disk drives that disrupt the disk drive makers that were serving the desktop market. Right? Desktop about and computers users storage and capability and portability, right? And so there's an asymmetry in those preference trajectories that by serving the notebook market, you're making progress on both storage and portability. And so every step you're making some progress with what the desktop folks want. Whereas if all you're thinking about is the desktop folks, you're adding more and more capacity, but you're not addressing the need for portability. And so these two notions of decreasing marginal utility and symmetry or asymmetry in preference structures across segments tell us something about what convergence or maintained divergence will look like. Right? There's an interesting paper, this is with Peter Zemsky, that kind of shows how this decreasing marginal utility actually it's when it comes to your ability to capture value from continued improvement. But where your advantage is being blunted is not in your ability to supply, but in the differentiability of offers in the market, right? And so the first point here for corporate strategy, where we think about, the difference between business strategy and corporate strategy is, well, what are the markets you want to play in? And the first notion here is that market convergence upends scope decisions, right? If diversification is about being in separate markets, here's the dynamic where markets that start separate collapse into one. So that was the first set of ideas I wanted to share. The second set of ideas is to do with classic views on strategy, kind of the stuck in the middle kind of debate, where we think about, well, do you need to have a coherent strategy to win in a market, right? The classic Porter low cost differentiator positions. And the first thing that pops out when you start thinking about demand structure is the realization that in order for a differentiator and a cost leader to both succeed in a market, they're serving different segments that actually, when we think about the production frontier that we talk about for so long, there are two frontiers, one for each segment. And the question that we take up in this paper, this is the only paper I'm showing the title for here, because it just won a Best Paper Prize in Strategy Science. So congratulations to my co-authors. The idea here is, how do we think about these two segments being served by specialist companies with focused strategies versus when is it that we might actually see a generalist not be stuck in the middle, but win from the middle, or even potentially dominate from above? And the story here is to think about the extent to which these segments are different, like the degree of heterogeneity. And the degree of heterogeneity tells us something about how hard it's going to be to serve these two segments together, right? The more different these consumers are, the harder it is. The more similar they are, well, the more opportunity there is to seize scale across these two. And I think this gets to Kathy's question, which is, well, decline in a market segment is one thing, and it may induce firms to try to combine market segments to regain minimum efficient scale for what their production activities look like. And so what we explore in this paper is how the notion of scalable technologies, that is the ability to serve the market with a technology that is kind of very variable cost compared to fixed cost, right? How that interacts with the extent to which segments are different, the extent of demand heterogeneity. And that tells us something about when we expect a market to be served by different companies and when we expect multiple markets to be served by a single generalist, right? Again, this leads to the question of scope and corporate strategy. The other thing that comes out in this paper, though, that I think is really of critical interest to strategy as a field, regardless of whether we're thinking about demand side or not, is that as we think about sustainable competitive advantage and we think about entry decisions, what we show in this model is that the cost allocation decision that a company makes as they're thinking about entering and serving new markets is a critical determinant of whether they're going to see things as worth pursuing or not. right? And so whether you're allocating costs on the basis of average costs or marginal costs as you're thinking about entering these markets, turns out to be this critical decision. And again, if I bring it back to the question of how do we want to think about corporate strategy, well, we're used to thinking about resource allocation, but there's a financial reality that actually cost allocation can have a massive impact on how we think about resource allocation, right? So that's kind of the second idea that I want to land here is that as we're thinking about entry into multiple markets, there's a question of how do we allocate costs across those activities, and that itself will also shape corporate strategy. The next set of ideas, and I'll go through this quickly because I know we're short on time, again, apologies for the technical delays, is the realization that part of what makes customers different is what it is that they're going to use your offer with, right? Whether there's a set of required complements or desired complements, right? So you can think about, if in the early 1980s, you could give one person a computer and right away they would start coding and creating all kinds of efficiencies with this computer. But somebody else, if you didn't give them packaged software and a graphic user interface, they couldn't use that same technology at that same level of performance. And for them, that computer would be a paperweight. And so this was actually my entry into thinking about what's going to look at like ecosystems in a minute, is the question of what else is required in order for a product to deliver its value, to deliver on its promise, and how might that change across different customer segments, right? And this is kind of thinking about how we shift from products to notions of solutions, and why, in all my later work, really I anchor everything in this question of a value proposition. To what extent does your product embody your value proposition versus you need other parties to participate, right? When we need other parties to participate, that brings us into this notion of ecosystems. I'll say just a couple of words on ecosystems and corporate strategy. So, there are different working definitions of an ecosystem. Mine is that the way I found it to be helpful to think about ecosystems, this kind of ecosystem as structure definition, is that there's a value proposition, and the ecosystem essentially tells us something about the partners that need to collaborate to deliver the value and the structure through which they're going to interact. All right, in some early work with Rahul Kapoor from the semiconductor lithography industry, right, one of the interesting things that we explored was how does the choice of vertical scope for a company get impacted by the presence or absence of innovation challenges elsewhere in the ecosystem. And kind of the realization here is that scope decisions are impacted by multilateral interdependence, right? That as we're thinking about where we want to play, there's a bigger canvas, and that as we're thinking about kind of make or buy type decisions, they solve some kinds of problems, right? The behavioral uncertainty of, is someone going to fulfill the contract? Someone's going to be incentivized to do the work we're at. They don't solve other decisions, like the technological uncertainty of, can they figure this out? And again, as we're thinking about why it is that we're entering different markets ourselves rather than contracting, right? The heart of corporate strategy, understanding this broader landscape and what it is we're trying to accomplish in terms of delivering a value proposition to a particular segment or another segment, I think is another interesting question for corporate strategy. Do we have a hard stop at 10, Teresa? Or no? All right. So
No, we
I'll
don't.
go for
No, we don't.
a little bit over. The picture up here, this is a relatively static view of what an ecosystem is, right? This is, multiple partners collaborating within a structure. I think the age that we are living in right now actually makes ecosystems much more focal, because the structure itself is being redrawn by different entrants, different entries, different ambitions, and this is changing the nature of threats and opportunities in the market, right? And this is what I think of in terms of ecosystem innovations, that actually, if you think about that first definition, an ecosystem innovation is what changes it. It alters the structure, the membership, the roles, as we're creating these new value propositions. And, two things that come from the shift in motion One, I looked at in a paper with Marvin Lieberman and also in my book, this notion of disruption through complements, where we can have a change in the relationship between partners, right? So the example here would be, if you're making digital photo printers, in the beginning of the story, cameras are a great complement, and as cameras improve and become more ubiquitous, more people are taking more pictures, so more people are printing photos, and you're making more money with ink and paper. But then this complement, the camera, gets to a point where its value proposition gets to be too good. Right. So if we think about, what happens as the iPhone moves to a retinal display, and now the quality of the image that you see on the phone screen is as good as what you can get from a printer, if not better, then whereas in the kind of this midpoint, the early iPhone, it was great to be able to look at the screen so you know what you're pointing at. Here, this complement has become a substitute. Right? This is the idea of value inversion. And what this leads to is a very, very different kind of competitive dynamic than we saw in the earlier notion of disruption, right? Where it was a substitute coming from a different market that was collapsing your definition. Here, it's a complement that was sitting in your market. We had thought about them as occupying a different quote unquote industry, and now they have collapsed the industry boundaries within our game and transformed what it is that we're trying to compete for in the first place, like the whole notion of what our added value is going to be defined by, right? And so again, from a corporate perspective, the basis of scope decisions is being upended, not just by rivals and their home markets, that was the previous discussion, but by partners in our current market and how those boundaries are being redrawn. And then the final idea that I wanted to share was this idea of corporate strategy as driving the alignment that is envisioned for new propositions. This is an example from Winning the Right Game, where the idea is we're trying to build an ecosystem. We have an idea of partners that we want to use. We succeed in one ecosystem, and then entry into another ecosystem can be facilitated by the deployment of partners from the first ecosystem to help jumpstart a position in a second ecosystem, meaning the way that we enter new markets, the way we expand, has this relational carryover. And it's a very different notion of relational-based theory of the firm, because it's not about you and your suppliers, it's about you and partners that are being redeployed into a new position. But a little different from the traditional redeployment literature in the sense that we're not removing them from the first ecosystem. Rather, we're using them to help build a position that then helps us drive alignment in a new market environment, right? And in this way, by the way, we can see firms create relatedness, right? Markets that in the beginning look totally unrelated become related, right? So like the case that I study, I study here is the case of how Amazon, with their Alexa speaker offer, takes what had been regarded as three different industries, smart home hubs, audio speakers, voice assistants, right, combines them into this Echo Hub and kind of blurs the boundaries between those other industries, making them no longer viable as independent entries, and redefining a new market space, right? So here we think about as partners as idiosyncratic corporate resources, and there's an interesting sub-story here about how we think about the new tension this creates between BUs and corporate headquarters in terms of whose resource is this to deploy, and that takes us into like the internal ecosystem organizational dynamics that I think also are worthy of further study in the context of strategy. So, all right, that's really what I want to share. This is the list of the papers I touched on. The directions to pursue here are the interplay between changes in demand heterogeneity and technology scalability, the idea of scope decisions in the face of boundary redefinition, right? As opposed to thinking about these industries as static constructs, cost allocation as a critical lever to think about, BU versus corporate decision rights, and we didn't talk about it, but kind of M&A through an ecosystem construction lens. So that's that's what I had to share. Again, apologies for the technical problems. I'll stop, and if there's time for further discussion, I would be delighted.
Thank you so much, Ron. That was fantastic. Yeah, I think I would be more than happy to stay a couple of minutes longer. I think there's definitely the possibility to do so technically. Is there somebody in the audience who does have a question right now? Please feel free to simply unmute yourself, turn on your camera even if you like, with questions for Ron or for Deepak. Maybe in the meantime, I can ask a first question. Both of you, so Deepak has talked about client-led diversification. Ron, you've stressed, however, there is this heterogeneity in clients and this heterogeneity in demand, or I would think about it as within industry heterogeneity even. So as a multi-unit firm, should I basically strive for this market convergence, this alignment that you've talked about? Should that be something as a corporate strategist that I should try to make happen? And that's something maybe that I could do relative to a single unit or a single business firm.
You know, I wouldn't necessarily say that it is always to the firm's benefit that this is happening. Okay, what I would say is it's always to the firm's benefit to recognize that this could happen, whether, you know, as an opportunity that they want to drive forward, or as, you know, somebody else driving this convergence, so they want to be prepared. And the question in the chat from Kathy, I thought was a really good one, which is sometimes there really is a zero-sum game where, you know, one firm is growing, another firm needs to shrink, and then thinking about how you want to shrink is a neglected strategic choice. I'd actually, you know what, I have two papers with Dan Snow, this idea of a bold retreat, which is when you realize the news is bad, how do you figure out how to respond? And the reason that we called it bold retreat is a retreat because it's bad news, but it's bold because you're doing it proactively rather than collapsing in the face of a fight that you're losing. So I think I mean, Deepak, you can jump in, but that's my answer is it's not one way this is better, but we certainly do want to be aware of it as both opportunity or threat.
I think the only thing that I would add is that there's two interesting things that are potentially driving this type of convergence in markets, also potentially divergence as well. One is innovation, right, which Ron very nicely illustrated, sort of certain types of innovation that bring markets together. But the other could be also that there's sort of preference changes happening in markets more generally. And it's kind of interesting to think about the implications of these that could be different. And also on the innovation side, I think one could think about innovation that are primarily cost-driven, so that a particular technology becomes so much cheaper than the alternative that everyone adopts it, which is kind of much more aligned with the Christensen argument, versus, in picking up on some of Ron's work as well, technologies that become more general purpose, more able to provide multiple functionality, right? And I think that there's sort of useful grist for the mill there in terms of looking at the impacts of these different types of changes.
So yeah, I really appreciated this win from the middle analogy that you mentioned, and I was wondering if that was sort of also at the core of my question. If basically multi-unit firms are potentially better positioned to be able to do that, and it's probably not the typical competitive strategy that we would suggest, but it might be one that is available in particular to these multi-business firms. But I don't want to take up too much time. Maybe there are other questions in the audience. I know we also have usually lots of PhD students here, so also feel free those of you who maybe also have more clarifying questions, or maybe I can ask the question that usually I think also interests PhD students quite a bit. What would you suggest in terms of, I know you've both suggested areas for future research, but maybe especially for the PhD students here, is there a context you think is, I don't know, particularly relevant at which these research questions could be studied, or a certain data source you think would be particularly exciting to explore? I know I didn't share this question with you in advance, so maybe you needed to think about this, but that was just
Well, I think for me, part of what makes the current moment so interesting is that we're seeing these, if we go back to that discussion about the paper with Peter and Fran, the availability of scalable technologies, that is, technologies that can be deployed with relatively low variable cost, right, makes it easier to span segments. And if you think about everything that is now kind of IoT, cloud related, et cetera, everything that's based in a centralized server, that's a very nice instantiation of that kind of shift, right? And so we can think about, a multitude of different industries where that is happening, and you can look at how that is changing the nature of demand, of the structure of demand. Right? We can think about it from that side. We can think about like, who is it that is able to serve this demand? And so I think there are plenty of empirical opportunities to study this that are actually, quite close to allowing you to use predictions from the theory.
Thank you. I think this is incredibly helpful. Yeah, thanks.
I think one thing that's really interesting that our current economy enables, which so in some ways is a throwback, right? So if you think about how production used to occur, if you went back 250 years or even 200 years, is that a lot of production was very customized to a particular customer, right? So there were products that, you went into a blacksmith and the blacksmith made this particular sort of tool or implement for you. And we went through this massive period of industrialization where we first sort of started with interchangeable parts, and then all the economies of production assembly lines and so on, that we've sort of gone towards much more standardized products. But especially with AI and data use, and particularly scalable use of these types of digital resources, at least in some domains of the market, you now have the possibility of at scale providing very customized products or services to individuals. And I think that that's like a super interesting phenomenon that is in some ways a throwback, but also connects, for example, with what professional service firms have done for a while, which is their products are almost always custom to a particular customer. But now you can do this at scale. You can do this for run-of-the-mill consumers.
Perfect. I think this almost answers maybe a little bit a final question we received in the chat, and I think this should probably be the last one before we wrap up. Vincent has asked, how can we think of AI as a factor of convergence and scalability?
That's a really good question. And I think probably for me, the productive way of thinking about AI has been really not thinking about it as, the general purpose technology on its own, but rather where is it that it will be impacting things in different ways. Right. So if we think about kind of this notion of a value architecture, right? A firm has got a theory of what it is that's driving customers' willingness to pay for their offers. From there, we can think about how we construct that value proposition, right? Kind of the actual ecosystem. And then locating what AI might do within that map, I think has been allowed for, at least for me, to have a little bit more traction in terms of what's happening. I think the thing that makes the whole thing so challenging, of course, is how quickly the proposition AI itself is changing, and without a clear sense that it's going to slow down anytime soon. But I think we're trying to navigate, my anchor is its impact on the construction of that value proposition, rather than just let's treat it as a general purpose technology and be stuck in a fog.
So definitely not only convergence, but potentially even the opposite.
Yes. Well, it's interesting, right? Like we can think about there's convergence and divergence operate at different levels of the hierarchy, right? And so, the cloud providers, that is massive, massive convergence, right? They can, out of AWS, you can serve every single industry in the world. Further down, getting closer to the specific value propositions is where we might be able to see a lot more divergence, a lot more entry. Yeah, for those interested, I would look at winning the right game.
Okay, perfect.
That's
I
fine.
think Deepak, your final answer, and then we probably have to wrap up because I think there's a hard cut in 1 minute.
Yeah, I don't have anything else to add. I already just mentioned AI and sort of potentially impacts on the demand side from AI earlier. So I think this is a good place to stop.
Well, then thank you so much, the both of you. This was incredibly insightful. It was wonderful to have you. Thanks again for your contributions to the corporate strategy interest group. And yeah, I hope we will continue this dialogue at conferences and whenever.
Great.
Thank you,
Thanks, everyone.
Teresa and Lisa. Really appreciate the organization.
Bye.
Thank you. Bye-bye. Bye, everyone.